This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Robert Carver. Robert is based in London. He has quite a bit of systems trading experience. His book is called Systematic Trading, can be found everywhere. Robert is formerly with Barclays Bank and with AHL, the famed trend following manager, founded by David Harding, Martin Luke, etc. Robert brings some really down-to-earth systems trading perspective. If you are new or if you are experienced, I guarantee Robert will illuminate some of the most important systems trading issues that there are. There are no secrets. There is no black box. There is no magic. But there is common sense. I hope you enjoyed this conversation with Robert Carver. Robert, as I was getting ready to talk to you today, and I'm going through your work, and everything's extremely detailed, but I'm thinking, when did this man start with the word system? Where was he? How old was he? What environment was he in? What understanding did he have of money and markets before the word system came into your life? And when did that happen? How did it happen?
So I was pretty early on in my financial career, actually. So I did a few things early on in my life, which I never ended up continuing with. And then at the age of 24, I decided to go back to school, get my university degree. And it was in my final year of university that I did an internship with a quantitative trading firm called AHL. So that was the first time I began thinking about trading in a systematic way. Just before I'd worked in an investment bank or traded my own money or done any of those things that other people may have done earlier in their lives. So systematic trading has been really a part of my thinking in my life from a relatively early age, so from my late 20s, and in terms of my investment career, almost day zero, really.
At what point in time were you at AHL?
So I did an internship there in the summer of 2001. And then I went back to school, finished my final year. I worked for an investment bank for a couple of years. So did the other kind of trading, what I like to call discretionary trading. Did a couple of years working in an economic research centre and just sort of developing my quantitative skills there. And then I came back to AHL in 2006. And I was there from 06 to 2013, which obviously were pretty exciting and pretty scary years to be working in finance.
Before I go into some of that 08 time period, the crisis, you've got a lot of interesting experiences at that moment in time, things that you saw firsthand. But I'd like to dig a little deeper on the word system, and that when you got to AHL as part of your university program, what did you understand? I mean, was there a particular person or was there a particular event that took place where the system was put across your desk, so to speak, the word, and you had this light bulb moment? Was there ever a moment, or was it all very gradual?
I would say it was gradual, and as I said, I've never really thought about finance in any way apart from a very systematic way. And one of the reasons I think I found it difficult in the investment bank environment, where the trading we were doing seemed to be mostly on hunches or sort of seat of the pants stuff. I found that quite difficult. So I'm much more of a kind of person who's very comfortable with numbers, who's very comfortable with a very formal way of doing things, who is very comfortable with using an algorithm to sort of decide what your thought process should be.
I want to read something really quick. This is from the opening of your work, Systematic Trading. You're quoting Daniel Kahneman. I think it's a great quote to set the tone for our conversation today. Quote, "In every case, the accuracy of experts was matched or exceeded by a simple algorithm. Why are experts inferior to algorithms? One reason is that experts try to be clever, think outside the box, and consider complex combinations of features in making their predictions. Complexity may work in the odd case, but more often than not, it reduces validity." end quote. And that's Daniel Kahneman, Thinking Fast, Thinking Slow. That is such a perfect way to sum up the direction that you like to go. Obviously, I relate to where you like to go as well.
Yeah, absolutely. I mean, if I have one sort of overriding message, is that I personally think most people are not as good as trading as they think they are. Ironically, as you say, it's the people who think of themselves as experts, who have a lot of knowledge and a lot of experience and have spent a lot of time trading, who are more likely to be overconfident and overestimate their ability. I think people rarely actually sort of evaluate themselves critically and actually properly work out how well they've done in their discretionary trading activity and look at statistics properly to really examine whether they genuinely are doing much better than a system. I think a lot of people out there are probably fooling themselves, and they would actually do a lot better with a simple system. Don't get me wrong, I think there are some incredibly good traders out there, but I think they make up a very small fraction of the population of people who are involved in finance. And for the vast majority of what I think of as ordinary people, and I include myself in that, people who aren't these rare geniuses, then just using a system is definitely the way to go.
You talk about the self-critical aspect, and as before we get into your definition of a system, I was thinking, here I am, home for the holidays, so to speak, around family and friends. And I think most people can relate to this. If you haven't been around for a while and you see a lot of people that you've known for a long time, often they're bigger than when you saw them last time. And what's amazing is the self-image hasn't changed at all. They're still Olympic champions. They're still running the 10-second 100 meters. They have no perspective and no measuring ability of what's happening to them personally. And they're still in this state of not measuring, so to speak.
Absolutely. I mean, I got back on my bike today after a couple of weeks just eating and drinking and getting fat, as you say. And it was I thought I was doing okay. And then I came home and sort of downloaded the statistics from my ride and was quite shocked to discover, how unfit I'd become in just a couple of weeks when I actually looked at the statistics.
Measuring and counting does a lot for our lives, whether it's exercise or investing. Let me jump into system, because I've talked about this a lot in my podcast, but I think sometimes when I talk to new people and people with different perspectives and you go very in depth into your work, how do you define a system, a trading system in the investing world? How do you look at it?
I think there's some key words that I need to think about here. So a system must be objective. It must be repeatable. It must be transferable. So you talk to a lot of people, particularly from what I call the sort of older tradition of pattern matching in technical analysis. These guys look at charts and they see patterns in those charts. And they claim to be systems traders because it's only when they see these patterns that they will actually trade. The problem is if you get them to write down an objective rule that can be formalized and turned into a computer algorithm, or even just written down sufficiently well that someone else without any experience of that could identify these same patterns, they seem unable to do it. So that suggests that what they're doing isn't really systematic. It may be a little bit systematic. They're not just throwing darts at a dartboard, but it's not completely objective. It's not transferable to another person. And it may not even be repeatable by the same person. So they may see slightly different patterns on different days and say, oh yeah, that's a buy, that's a sell. But, they're not applying a completely objective rule that you could formalize in an algorithm and therefore get the same results every time. So if you're not going to get the same results with a different person using your system, if you're not going to get the same results yourself when you use it every time on different days, then you're not really a systems trader, in my opinion.
I had someone email me the other day, and they were talking about a price action-based system. And the follow-up question was, but I need to use charts, right? So here they were right in the middle of going down the right path, but there was still this pull to the lore of chart reading that you just talked about. It's a definite confusion point, and I'm sure you found this confusion in your career trying to get people to understand your objective, systematic way versus what many people, they're first thrown into the Bloomberg or CNBC expert that comes on TV and says, well, this pattern indicates that XYZ market will be here in 2 years. I tend to think when people are in that I want to read charts phase, They really want to get to where you are. They just don't see the difference yet.
Absolutely. And I think part of the problem is that this illusion of overconfidence. There's this view that you need to be an expert to do a good job. If you can write down what you're doing so that it's perhaps just 2 or 3 lines of code, or 2 or 3 simple steps, or a spreadsheet with just half a dozen columns, then there's the view that that can't possibly be any good because it's too simple. It's not, it doesn't have enough expertise in it. It's not something that you need 10 or 20 years of staring at charts to be able to do. And so there's this view that people have that it can't possibly be any good. It can't possibly work. And, the more complicated and the weirder and the more subjective the patterns are, the better, because then the logic is that you're going to be one of a small number of people that can actually do this, and therefore you're more likely to make more money. And it's just not a view I sign up to at all, unfortunately.
Robert, why do you think, for those skeptics out there, perhaps those that have made it to the I want to read charts phase, why do you think those skeptics don't find themselves eventually looking for evidence? Now, there's no guarantee that past performance is going to dictate the future, but it is quite interesting to look at some of the systematic traders over the decades, and easily over the decades, to look at their month-by-month performance. And there's something that can be gleaned from that. There's success, confidence, etc. Why do you think people don't sometimes make the leap to look for evidence when the evidence really is hiding in plain sight?
I think part of the problem is that most people can't really judge what is good evidence and what is bad evidence. So most people don't have a good intuitive understanding of concepts of statistical significance. So if you were to ask somebody, what constitutes a track record that's long enough to make a judgment such that you know that a particular fund manager or a particular trader or a particular trading system isn't just making money through luck, but is actually adding value, and you assign a probability like, say, 95%. So you want to be 95% sure that this isn't just a fluke. And most people will massively underestimate the amount of time and the amount of data you need to actually make that judgment. In practice, unless the trader is highly skilled or the trading system is incredibly good, and I'm now talking about, the sort of returns that high frequency trading firms can push out. Unless you're in that realm, you do need an awful lot of history. And I'm talking about multiple decades of history. And now when I analyze trading systems, I've normally got just about enough data to make a judgment that a particular system, is probably, well, at least was profitable in the past, because as you say, there's no guarantee the future will repeat itself. But an individual trader, unless they've been in the game for an awfully long time, and unless their trading style hasn't changed so that, they're doing the same thing they were doing 30 years ago, and so they can use all of their data, it's very unlikely to be in a position to actually say, yes, I'm not just lucky, I am actually good. So most people confuse luck with skill. And I think that's part of the problem, because it's very easy to get into the game of just looking at charts, and, you get a pretty good chance of, even if you were just throwing darts at a dartboard, or even if there were no value in these charts at all, you've got a pretty good chance of being one of the people who manages to make some money in the first couple of years of trading. And then it's going to be very hard to step back from that and say, well, actually, I'm doing something that really isn't going to add any value, because you're probably not going to have enough evidence that that's the case or is the case. And so you've got the natural tendency of people to view themselves as being much better traders than they've been, and to ascribe the fact that they've made some money for a couple of years to some skill or some ability to read these charts.
Let's break apart systematic trading across the different time frames. You mentioned high frequency trading. Let's say that's on one extreme, and then maybe a very slow form of trend following on the other extreme. Both of these strategies can be made systematic, but they're quite different. That difference is often lost on many investors, isn't it?
Absolutely. I mean, most people, if you talk to them and tell them that you're a systematic trader, they assume you're what is often called an algorithmic trader, which means you're very much at the short time period, the extreme of the high frequency traders who are holding positions for tiny fractions of a second. It is quite hard to get across the You need a completely different mindset to trade systematically in these different areas. If we take some famous people like, say, David Harding, who runs Winton, but obviously was also one of the co-founders of AHL. He's a very smart guy and a very able guy. And then you've got someone like, I think his name is Umsweet, who runs IMC, which is a Dutch high-frequency trading firm. Again, a very successful guy. And both of these guys are dollar billionaires, so they've done pretty well in their chosen field. But if you were to swap them around and get them to run each other's strategies, I think they would struggle, because it is a completely different world. I have almost no conception of what the high-frequency guys do. They use techniques which would make no sense at all I believe, in the lower frequency world, because they have a lot more statistical data to look at. Whereas, the very low frequency trend following, perhaps kind of tactical asset allocation models, you really don't have as much data, and you need to have a much better handle on running strategies that make a kind of economic or intuitive sense, rather than just being a set of weird nonlinear patterns that appear in some short-term data.
But what's amazing is, even though they can both be so different, they might be completely lost if they switched places. The commonalities, the reasons why they have, and I started with that Daniel Kahneman quote, the reasons why they have put themselves, their companies, into a systematic approach. This goes back to Kahneman's work, doesn't it? This gets right at the psychology level, the human behavior level of all of us. We're not exactly rational, and there's some very common sense reasons for systems to work and to stick to them, whether it's high frequency or trend following.
Exactly. I mean, it's definitely the case that the most successful systematic traders are those that are running systems that make some kind of sense. And that might be, the high frequency area that, you make sense because you're essentially being paid to provide liquidity in the market, whether that be implicitly through the bid-ask spread, or whether it be through, rebates in the US equity markets, or, these sort of dark pool things that are going on. And then, going back to the sort of slower trend following, there's all kinds of theories and explanations as to why, trend following has worked in the past, and I personally believe will work in the future. One of my favorites is a behavioral finance theory called prospect theory, which was developed by Kahneman, his co-author. And that essentially relates to the way that people treat realized gains and realized losses differently. And that's a really neat little theory that essentially explains why people really struggle to invest in trend following strategies, and therefore why those are profitable to computers that don't suffer from these, emotional faults. And the second aspect that people at both ends of the spectrum have is that, they stick to their systems, they believe in them. In the high frequency world, well, you don't really have much choice. You're trading so quickly that as a human being, you can't really sort of step in and try and meddle with what the system's doing. It has to run, fully automatically. As a slower systematic trader, it's more tempting to meddle with the system, to change parameters or, override it in certain situations. That's more of a danger. But I do believe you'll be more successful if you can avoid the temptation of doing that.
Let's go ahead and break this apart a little bit. You've got a great story in your book, leaving the hedge fund industry at one point in time, and you visited a shop and you called it Aqueduct Capital. Why don't you relay that story? I thought that was some nice color for people that do have an understanding of what a system is and perhaps are trying to test it and come up with a belief in their system. I thought that little story of visiting Aqueduct Capital was really enlightening.
Shortly after leaving the hedge fund industry, I began discussions about consulting and managing some capital for Aqueduct Capital, a local proprietary trading firm. The office contained the usual mixture of grizzled ex-life traders and naive youths, all day trading a handful of futures contracts. But the boss was particularly proud of his quantitative team, which consisted of a couple of 20-somethings, toting PCs running an off-the-shelf back-testing software package. "This is Joe. He's only been here a month. and he's already come up with 50 new trading rules that are profitable in backtest, explained the boss. Yes, this software is amazing. It can automatically test hundreds of rules a day, added Joe. I managed to keep a straight face and reply as diplomatically as I could. Well, I'm sure some of them will work.
You walk into the room and there's all this excitement. We've got the latest and greatest backtesting software. We've got some floor veterans. We've got some bright-eyed 20-something millennials. Everyone's ready to go. And my gosh, in a few minutes, we backtested a few things, and man, we figured it all out. Now, of course, on our limited time today, and I highly implore people to take a look at your book, Systematic Trading, we definitely can't dig into all of the elements here, but in terms of broad brushstrokes, help people to understand what you were feeling, even though you diplomatically, in a very British way, didn't say what you were really feeling.
Yeah, I mean, part of the reason why this story is kind of rings a bell with me is I've done it myself, although not to the same degree. I think it's very tempting when you get hold of some backtesting software and you have some good ideas to start playing with it and see what happens. So there's kind of a couple of things going wrong here. So the first is a very easy thing to understand, which is that essentially you're cheating. You're using a time machine. If you run a backtest over all the data that you've got, and then look at the results, and then decide, you know what, this model is good, I'm going to keep it, or this model is bad, I'm not going to keep it, then you're doing something that you couldn't have done had you been sent back into the past to 1975, say, when your backtest begins. You wouldn't then have been in a position where you had this 40 years of data available to decide which model was good and which model was bad. You would just have had to run those two models together over time, and then over time you would have gradually worked out which models seem to be doing better than the other. The second problem is that, and it's just kind of pure statistics really, if you test a lot of different trading strategies, even if on average they're all bad, some of them will look good for a given time period. And then this is just kind of the law of random numbers, if you like. Just as an example, let's suppose that you're going to be quite strict and say, well, I want to see something that has at least a Sharpe ratio of 1 in the back test before I even consider it. And so you then test 100 different rules, which sounds like a lot, but a lot of these packages, that's very easy to do, and they're probably not going to be 100 completely different rules. They're probably just going to be 100 variations on the theme with slightly different parameters. Now, on average, with 100 rules and a minimum Sharpe ratio of 1, 16 of those rules, so that's nearly 1/5 of those rules, will look as if they're good, even though in actuality none of them actually profitable. It's just luck that 16 of them over your backtest period happen to work pretty well. And this problem gets exponentially worse, and you have to reduce the number of rules you look at quite considerably before you get to the point where you're not going to have this element where even a bad rule is going to kind of slip through your net just by luck, just by the fact you've looked at so many different rules. So the lesson here really is that you've got to be ever so strict at trying to avoid looking at all of your data. And secondly, that you've got to try and reduce the number of variations or parameters that you look at. And I personally believe if you have an idea that you think is going to work and you try it, then one of two things will happen. Either the back test looks bad, and then it's very hard then to say, my idea was really bad, particularly when you're working for somebody else and they're expecting some return on the salary they're paying you. It's very tempting to spend time polishing it and changing the parameters and adding overlays and just generally messing around until you manage to improve the thing so that it looks good in the backtest. You're just fooling yourself. And the other alternative, which is nearly as bad, is if you have a rule that works well in the backtest, is just to try and improve it a bit more. And again, all these changes you make will improve the performance of backtest, but will make it quite likely that you've overfitted the thing. And then when you actually trade it with real money, although it was actually probably a sensible idea, you'll have completely destroyed the performance of it in actual trading.
As one sits down to put together a system for the first time, and I'm curious how you felt when you walked into, quote, Aqueduct Capital, talk about the advantages of ideas first in system building, the advantages of data first, and how were you feeling when you walked into Aqueduct? Were you looking at that as a data-only backtesting development, or were you thinking they actually had some ideas? But talk about the difference between ideas and data and the complexity behind that, because it's not necessarily an easy choice, is it?
No, so these are the two labels I use for the two main ways that people come up with trading systems, trading rules. Data first is what most people, I think, imagine you do as a systematic trader. And this is becoming an increasingly common perception as things like machine learning and neural networks and big data are all very kind of fashionable at the moment. People assume that what you do is you get all your price data and you drop it into some kind of giant optimizing machine, and that will pop a trading rule that will give you a good profitable account curve in all those data points. And now that data rule may not make any sense at all. It might be something like if the S&P 500 is down on a Tuesday and the moon is full, then buy pork bellies on Thursday. It could be something as random as that. And it may be actually, it may actually be a good rule. It may work. There may be some weird thing going on that means that rule works. There may be some investor who, for whatever reason, does big trades in those markets and makes the thing work. And if you look at someone like Jim Simons at Renaissance Capital, he's really been doing this very strange, non-linear trading rules for a very long time and very successfully. But that doesn't mean to say that its approach will work for everybody, because you need to be incredibly careful about things like statistical significance. You need to use some fairly sophisticated techniques. The alternative, which I call ideas first, is where you begin with an idea. So the idea could be kind of economically based. So it could be something like, well, central banks set interest rates according to unemployment levels and inflation. So I'm going to build a model which will bet on interest rates rising if inflation is rising and unemployment is falling, and vice versa. Or it could be based around a behavior. So, if you think that trend following works for whatever reason, then you can build a trend following model. Then once you have your idea and you build a rule that embodies that idea, you then go ahead and test it. So the important thing is, in both cases, you have to test it and make sure that you've got something that works. But with the ideas first, you have the additional validation that you know why it works. I like having that extra confirmation, that extra tick. I'm much more comfortable and happy running a model and seeing it, especially if it's losing money, understanding why it's losing money. It's just because that particular effect isn't working at the moment. Whereas if it's the weird thing where, you've got S&P 500 and pork bellies, because I don't really understand where that trading strategy came from, I'm not necessarily going to understand why it's losing money. And it'd be much harder for me to stick to the plan and just trade that as it is. When I kind of see people who are using data first techniques and using them in a bad way, it's kind of depressing. I'm not saying, both approaches work. They work better in different scenarios. So data first seems to work better for faster trading. Ideas first seems to work better for slower trading because there's just less data to work with. But generally speaking, I see much more misuse and really bad system design done by people who've just started with some data and then analysed it without really thinking about what's going on in the market and what the kind of underlying idea of their trading system is.
I want to take a side step for a moment and go back in time. And I'm going to come back to my next serious subject on this would be risk. I want to dive headlong into it. But I would love for you to go back to the 08, 09 time period. I was going to ask you earlier, and I want to come back to that. The most interesting experience that you saw in the catbird seat that you were in for your life, the lesson that changed you during that, that fall of 08, early 09 time period, what were you seeing on the ground from your perspective that really changed you? And how did that embolden you to the concept of a system, to the idea of using a system and being religious with that system?
I think what the crisis of '08 and '09 really taught me was that people often don't know what's coming. We're really bad at predicting the future. There were a small number of people who saw the credit crisis coming, and famously people like John Paulson, and who also managed to place bets in the market and do well out of that. But if you go back to January 2007, you would not find a single macroeconomic forecaster who would say that, in 2 years' time, the US is going to be in a very serious recession. You would not find analysts of banks and mortgage companies who would say, a couple of years, pretty much every institution that we're covering, without highly complex analysis, is either going to be bankrupt or being rescued by the government. None of those guys had a clue, apart from, as I said, a very small number of people. But if you look at what trading systems did over that period, they didn't try and forecast what was going to happen anyway. But what they did do was kind of in mid-2008 say, well, it looks like the equity market is starting to go down, so we're going to go from being long equities to flat and then short equities and long bonds.
But hold on, as you say that, though, it looked like that in the context of a system. That wasn't just a gut feel that they pulled out. That was just like, that was the system that was, quote, feeling that.
Exactly, that was the system. So, in contrast, in early 2007, and I'm not trying to make myself out to be some kind of genius forecaster, because I've already said I don't think I'm, good enough to be a discretionary trader. I think few people are. But, we were following the news around the mortgage-backed security markets and those Bear Stearns firms that went down in February '07, which was almost the very first emergence of the credit crisis. And I did say to a colleague I was working with, who was running the systematic equity fund, I really think we're going to see, massive sell-off in equities here. Although I was right, I was also incredibly early. It was about 18 months before the sell-off actually happened. And the difference between me and the trading system was the trading system carried on being long equities until, much later when it saw the market turning and then automatically reversed its positions and then did incredibly well. So, you kind of got three groups or four groups of people. You got a large number of people who had no idea what was coming, and even well into the crisis, were still forecasting that there was going to be 5% earnings growth in banks year on year. Then you had a small number of people like Paulson who saw what was coming and were able to bet in such a way that they actually made money out of it. Then you had people like myself who saw what was coming, but not through any special skill necessarily, and weren't able to capitalize on it. And then you've got the trading systems that had no idea what was coming, didn't care, but just adjusted their positions according to the market movements as they came. The thing that really encapsulates it, and it's an anecdote I tell in my book, is the fact that in the sort of real middle of the crisis, so when AIG was going down and Lehman's was going down, and Freddie Mac and Fannie Mae were in trouble, we were as human beings sitting in our office, we were absolutely terrified and spent our days running around like headless chickens, going, what are we going to do? What are we going to do? The market's in a terrible mess. The world's going to end. And if we were human beings who'd been actually, making trading decisions, we probably would have just sold everything, bought gold bars, and just moved to Switzerland. And that wouldn't have been a bad trade. But because we were running a computer system, we kind of seriously asked ourselves, well, should we just turn this thing off? Is it safe to leave it running? And while this was happening, the computer system itself didn't know or care about us being scared, didn't know or care about all the bad news in the market, only in as much as it saw the price patterns and, put the appropriate position on. And 2008 was one of the best years for that fund ever. It was a real contrast between scared, emotional humans and, a computer system that had no emotions, was not scared, and just carried on doing what it had always done. The market moved, it put the appropriate amount of risk on. It didn't think, well, this is a really scary environment. It just scaled its positions according to the risk it saw in the market and was very profitable.
You lay out the good example of a systems trader a system, sticking with it in the face of utter chaos. Is there a negative to being a staunch systems trader? Staunch being a word that I've seen you use in your work.
I mean, there is a negative in the sense that, well, there's a couple of things. Firstly, I do believe that, that there are some people who can do much better than a trading system can. So if you're a really amazing guy who can look at price patterns and flows in the market, and think about economic implications, and forecast things like Paulson did, for example. You couldn't have made the short mortgage trade that Paulson did up to 2007 using a trading system, because you don't have that element of repeatability. The situation that we were in 2007, where we'd had house prices reach unprecedented levels, where we had this huge bubble of mortgage-backed debt, that was unprecedented. And if it had happened once a year for the previous 30 years, then yes, you could have built a model that exploited that. So that's the first disadvantage. As a systems trader, you're never going to be as good as the very best discretionary traders. But most of us aren't going to be the very best discretionary traders, so we should just forget about it and stick to a system. There is a second thing, which is there are very rare occasions when you do need to intervene with your trading system. And just a couple of examples from my career would be, once there was going to be, or there was a coup in Thailand, and we knew there was a pretty good chance that they would suspend the convertibility of their currency and impose capital controls. So we kind of quickly shut down our positions in Thai baht, and the system didn't know about this. And it's not that we thought we could do a better job of forecasting what the price would do than the system could. It's just that we knew that trading that market would be impossible, and therefore we should just stop trading it as soon as possible. And the second situation was when one of our prime brokers, MF Global, got into serious trouble when John Corzine was sort of ran it into the ground. And again, we knew a few days in advance that was likely to happen. So, there were a few markets where we were trading with them as our sole prime broker. We had to get out of those positions, or risk being in a situation where we'd be losing client money. But I'm talking about two, and I could perhaps add 3 or 4 more times where over a 7-year career, where it was the right thing to do to intervene with the system. But that's how rare it should be. I'm not talking about changing the system every month to see what your perception of risk is at the moment.
You mentioned the discretionary traders. Some of them being so exceptional, so much excellence. You mentioned John Paulson. I can think of a name like Michael Burry. Their way that they define risk would have to make most systems traders pretty nervous, because for as many Paulsons and Burrys as there are, of course, survivorship bias starts to play part of my thought process here. I want to say, well, who didn't get the timing right? Maybe they had the same idea as Paulson and Burry, but they didn't get the timing right, or at some other point in time in history, somebody took that kind of bet and they just became a footnote in history. It just seems like the risk for being an individual that gets classified as an excellent discretionary trader, the way that they classify risk seems much different than the systematic styles that you and I are talking about. Or am I completely wrong here?
Well, I'm going to think about the problem in a couple of different ways. So one is to take the view that Nassim Taleb takes in many of his books, which is if you were starting out your career and you sort of decided you were going to be a trader, should you go and be a discretionary trader, or should you be a systematic trader? And I think if you're going to be a systematic trader, then you're likely to be able to earn, assuming you're trading your own money, an average of maybe 10 or 15% a year is I think is a reasonable expectation without taking on too much risk. Now, if you're an absolutely top of the line, discretionary trader, then you could probably increase that number many multiples. But the point is that 99.9% of the people who go down that route will probably fail. The high end is better, but the average and the dispersion is an awful lot worse. The second thing is that in terms of styles of trading, and this isn't really a systematic versus discretionary thing, it just comes down to different trading strategies and different return profiles. the kind of bets that Paulson was doing, where bets where you take potentially a number of small losses for many years, and then you have huge outsized returns in 1 or 2 years. Now that's actually on the same kind of side of the playing field as trend following, where typically maybe 6 out of 10 months you'll lose money, but in the 4 months where you make money, you'll make much more, and it all comes out ahead. So they're actually more alike than you might think, and that's quite distinct from, to use a technical term, a negative skew style of trading, like something like, FX carry, or taking the other side of the John Paulson trade, where you're doing something like selling credit insurance every year, and you get lots of small gains, and you feel good, and then every few years, you have a huge loss and you get wiped out. The way that you think about risk management and the way that you think about the psychology of those two sides of the risk spectrum are quite different. But the Paulson, lots of small bets, occasionally large payoffs, is more similar to trend following than it is to the other side of the field, where whether you're trading systematically or discretionary, you're getting lots of small gains, which psychologically feels better. But occasionally you're going to get these huge losses, and you have to risk manage your system carefully so that those huge losses don't wipe you out.
Should you have from your perspective, one trading rule for all markets, all instruments? Big question, lots of depth. You've written a book on this subject, so people are going to go have to read it. So I'm only going to get a few minutes out of you on this.
In general, yes. So, if you look at things that are similar, so, I trade my own portfolio about 40 futures markets, covering most asset classes, most countries. And the only distinction I make between them is the cost of trading that market. So I trade cheap markets quicker, and I trade slow markets I trade expensive markets slower. So something like, Australian interest rate futures, I trade really slowly because they're really expensive. Something like NASDAQ, I trade a little bit quicker. But the difference in fast and slow here is not that much. You're talking about maybe at one extreme a 2 to 3 week average holding period, and at the other extreme perhaps a 2-month holding period. So they're not that dissimilar. But on the other hand, would I use this set of trading rules to trade something completely different, like pairs of US equities? I'd probably use a different set of trading rules for those. But if you're talking about things that are fairly similar, then generally speaking, there isn't as much evidence to suggest that you should trade, say, UK pound versus US dollar currency futures differently from, yen dollar currency futures, and even, different again from, US equity futures. You do see the data, some differences, but they never really come out statistically significant. And this is actually, a real hardening of my attitude to this subject, because, if you go back 5 years, when I was at AHL, I would have said that there was much more evidence, or it seemed to me at least that there were good reasons to trade different things differently. But now I kind of feel I don't really see the evidence for that. And I think especially as an individual investor who's doing your own research and doesn't have teams of people, you should do the absolute simplest possible thing that makes sense, and then only do something more complicated or fit it to different markets where you can find incredibly strong evidence that that's the right thing to do. And I rarely see that evidence looking at just futures markets.
Break apart. And I know this gets political when I mention his name for some people, but break apart Donald Rumsfeld's favorite descriptions: the predictable risks and the unpredictable risks, the known unknowns and the unknown unknowns. Break that apart, because I think sometimes people really don't allow themselves the time to think about what he was saying, which could sound kind of quick and cute and maybe political, but there was a lot of depth behind it.
Absolutely. So, risk is about unknowns. And if we knew what was going to happen next week, there would be no risk involved. But, there are known unknowns and there are unknown unknowns. So getting away from Mr. Rumsfeld, I would call those predictable and unpredictable risks. To predict something, you need to have some kind of model. You need to have some way of deciding, what's going to happen. So you need sort of the mathematical functions, if you like, and then you need to feed into them some estimates of what you think the number should be in those mathematical functions. Really, the most simple thing you can do, perhaps not the most simple thing you can do, but a pretty simple thing to do would be to say, well, I think that all asset returns are, what a statistician would call normally distributed, and they have a particular standard deviation or variance, and they have a particular correlation. Without getting technical, what that means in practice is that, you can summarize what you think will happen to asset returns with a relatively small number of variables. You can then kind of take things a step further and say, well, I don't think that this model predicts enough of the risk in the world. I want to make my model more complicated and introduce all kinds of other factors into that. And, a lot of people who are working in the quantitative finance world, this is what they do for their jobs. They come up with more and more esoteric risk models. Now, the danger with that is that the more complicated your notion of what the predictable risk is, the less and less you think about the unpredictable risk. The less and less you think about what Nassim Taleb calls the black swans, the things that come from you completely from left field. I think a good example of this is going back to the credit crisis. There were these models to price mortgage securities using something called a copula. And a copula is, something that's pretty complicated. And I think it was sufficiently complicated that the people using those models assumed that this completely embodied the world. And they forgot that a model is just a model. It's a simplification of reality. It isn't reality. Now, my personal approach is to go to the opposite extreme and say, you know what, I'm going to use the simplest possible risk model I can, which is the one I described to you earlier. And then I'm going to know for sure that there's an awful lot of unpredictable stuff that's going to happen. I've always got that in the back of my mind. And I'm going to sort of always make sure that I limit as much as I can my exposure to that unpredictable risk. And by nature, it's unpredictable. So, if the S&P 500 dropped 80% in one day, which has never happened, and, it exposed me potentially to very large losses. But at least I have in the back of my mind that something like that could happen. Whereas if I was using a more sophisticated risk model, I think the danger is I'd be thinking too much about the known unknowns and just kind of forgetting completely about the unknown unknowns, the unpredictable part of the risk model.
People are going to have to check out your work. Systematic Trading, a unique new method for designing trading and investing systems, is out now. They can find it everywhere, Amazon, all that kind of fun stuff.
Yeah, that's right. One of the best places to go is probably to www.systematictrading.org, and that's got a list of the contents and some more information about the book. And there's also links to sort of code and spreadsheets that you can use in conjunction with the book to design your own trading system.
Perhaps we can do this again in the future and kind of have part two, because I could definitely keep digging with you and go on for another hour easily.
Absolutely. Look forward to it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.